So many of you watch my stock analysis video, and every time I do a video, I talk about a stock, and then most of them I actually say, this stock is not a buy, this stock is not a buy. Now, many of you are actually sick of this and told me, just give us something to buy. Like, what is something, a stock to buy at least in the stock market? So I decided to do what my subscribers are telling me in the comments and actually talk about two stocks that I believe are undervalued in the stock market crash. Now, you have to be careful with this, and I have to say it. If a stock that I believe is undervalued, that doesn't mean that this current price is a bottom. That doesn't mean it can't get more undervalued in the future. I mean, Warren Buffett bought Paramount at $32, and you would bet Warren Buffett did a lot of homework. But now Paramount is around $18 or $19. He's down over 40% on his position. But you have retail investors, like whenever I talk about a stock and it goes down 10%, I get comments of people telling me, you don't know what you're talking about because you talked about this stock and it's down 10%, which is one of the reasons I'm very reluctant to actually talk about stocks I buy and things I do here. Is the reason why I created my group, which you could join if you would like to in the comments below or in the description, because the people in my group, they know that if a stock goes down but the business is still intact, or if the business went down but the stock went down more, it's good news to buy more of the stock. Retail investors, they don't know about selling put options to have a lower cost basis. They don't know about position sizing. They get too emotional. They go all in. So this is one of the reasons I don't talk about those positions here. But those are not recommendations, but there are two stocks that I believe are undervalued. All right. Now, the first one, which I talked about before, I'm going to talk about it again, is HZO, which is MarineMax. The stock was up pretty close to $65, and it recently went to around $28 or $27, and then it popped around, I believe, 15% on earnings, and now it's sitting at $32. And as you guessed, MarineMax is a boat company, so they have a lot of marinas they rent, but they also have 70% of their sales is from new boat sales. Used boats around 10%. They do maintenance and repair, storage. They have, parts, finance, insurance, brokers. So they have a lot of things, but most of their business is related, to boats and many other things. All right. Now, this company, the interesting part is, as you look, it's a cyclical type of business. But since 2015 to 2021, and even in 2022, the company is still growing revenue. It grew 16% revenue on compound annual growth rate from 2015 to 2021, and the company is still growing. Now, why is this actually happening? Because the company's management, they are masters at acquisitions. They get those deals that you never heard of, and they get them at pretty fair prices, or sometimes they overpay, but they create so much value from those type of acquisitions that they do that they can really kind of grow up the revenue, and then once they have more free cash flow, they use the free cash flow, they pay down the debt, they get a good balance sheet, and then they acquire more companies at dirt cheap prices, which is something pretty amazing. And I love acquisitions only if the management is experienced enough to actually not overpay and do them the right way. And MarineMax has proved many, many times over the years that the management is capable of doing strategic acquisitions that actually bring a lot of value to shareholders. All right. Now, this is 2022. This is their latest earnings report. Now, you would expect a boat company, just like any other consumer discretionary type of stocks, to actually be declining revenue 30 to 50%, or something like Best Buy or whatever. But MarineMax is completely different. Their latest quarter, which they just published a couple days ago, the revenue grew 16%. To $536 million for the quarter ended September 30. Now, how could something like that even happen? We're in a recession. We have a lot of inflation. How come the company is still growing 16%? All right. And how come, the company is actually even issuing guidance for 2023, which is something very few companies are actually doing. Consumer discretionary stocks like Best Buy, they don't even know what they're going to make in the next quarter. Yet MarineMax is issuing guidance for 2023, which they expect a flat growth between $7.90 to $8.40, which would imply around a 4 PE on this stock. Now, how come MarineMax is still growing revenues and it's still, issuing guidance for 2023? How can such a thing even happen? Well, it's mainly from the backlog they have. They have more orders than they can actually, bring online, which is something actually good for such an environment. Normally, it's not good because the company wants to maximize, but they had some supply chain issues and they had so many volumes of orders from 2021 that they actually can't even catch up on those orders in 2022, and they have till 2023, and they may not even be able to catch up on them. But if we look at the liabilities, which is, if you look at just contract liabilities or consumer deposit, it increased to 144 million. This is a record for the company, and this is more than the quarter of Q3. So we know that even now in 2022, the company MarineMax, people are still ordering boats and they are growing consumers deposits and backlog. Now, how is this happening? Because MarineMax, I don't have it, but I can put a screenshot on the 10K. Their average boat price is $260,000. Okay, so they are more on the mid end to the higher end. Over the years, MarineMax, they sold all the low growth, very retail kind of, low income type of businesses. And they are shifting to the yacht type of businesses, to higher margin, higher type of revenue. And you can see it with their gross margins from 24% in 2016. And now it's actually 36%, not around 35%. So this is, again, massive expansion for MarineMax. And as MarineMax demonstrated and as the management showed and talked about, they are more on the mid to higher end of the range, which is they get less, they don't suffer as much as other boat companies and consumer discretionary on the lower type of end of the range. All right. And as MarineMax is moving more to the higher end, they actually acquired a pretty interesting company the last quarter, and it's called IGY Marinas. This is only focused on yacht type of marinas, boat sales, maintenance, and many other things. They have around 23 marinas worldwide in almost 12 countries. And this is really on a very, very high end. I mean, as you could see in this picture, which those type of super and mega yacht type of businesses, again, first, they are higher margin revenue. Second, they are more kind of recurring type of revenue as the company, can really rent those lot spaces in those marinas, and this is recurring type of revenue. And third, the mega yacht and really wealthy people, they are more immune that, just other consumers whenever you have inflation or you have higher interest rates. So they are better positioned to keep their yacht or even buy a new one or maintain it, upgrade it. And again, MarineMax within IGY is going to give them even more exposure to recurring revenue and also more on the higher end, which is higher margin. All right. Now, the balance sheet is actually not bad at all. They have 228 million of, cash and cash equivalent, around 753 million of current assets. Now, their long-term debt is only 45 million. But the catch is they borrowed around 400 million to acquire IGY Marinas, which again, to some of you may be a concern. But again, they would still have around 150 to 200 million after they put up, the 100 million that they want to put up for IGY Marinas, which I'm confident the management can actually pay it mainly from their guidance that they issued, which is $7.90 to $8.40. If you use $8 and you time it by 4.15 or 4.20, you actually get around $32, which is the current share price. So again, the main reason I'm more optimistic about the company is I was worried about 2023. I believe 2023 is going to be the worst year for boats, consumer discretionary, and many other things. And in terms of higher interest rates too. Now, I think in 2024, we're going to have a better outlook, lower interest rates. Things are going to start getting better. So if the company can get through 2023 with their current backlog, they would be surviving, of course, in 2024. So this is why I'm more optimistic about the company. Now, that doesn't mean that the backlog is not going to be revised lower. But very, very rarely MarineMax actually revised something lower, or maybe they missed on it. They always beat. Even in their latest quarter, they even went beyond what they had in guidance in the fourth quarter, which is normally what MarineMax do. They go more conservative and they try to beat the number. And of course, it helps the share price and many other things. So again, and even, if the EPS is cut 20%, that's still 6 or 7 PE ratio. So I believe, after this whole thing is over and the bad sentiment around consumer discretionary goes away, MarineMax is going to keep growing, is going to keep, growing revenues, building up the business. And eventually after 2024, the market has to realize the value and it has to reprice MarineMax at a higher multiple. So this is my thesis with the stock and why I believe it's undervalued. All right. Now, the second one, which again, I talked about before, and of course, I'm going to talk about it again. And this is CSV, which is Carriage Services. CSV is more involved into funeral homes type of stuff. And this business is resilient. As people normally die every single year. This is nothing new and it's nothing bad to feel about. It's just human nature, okay? But what happened in 2020 and in 2021, they had a huge spike of cases because of COVID. More people were unfortunately dying, all right? And the stock saw huge volumes of, many contracts due to COVID deaths and many other things. And the stock skyrocketed to $65, all right? Now, this stock now is trading at $24, which is pretty close to 2018 type of levels, even to pre-COVID. But the company is a much different company than it was in pre-COVID, which kind of reminds me of, what happened in, 2020. People, they didn't want oil stocks or they didn't want restaurant stocks because they thought we would be locked down forever. Well, again, now people are thinking that because a lot of people died in 2021, people are suddenly going to stop dying. And the stock is really getting beaten down, and it may continue getting beaten down, which is why you should be careful not going all in with such type of investments, all right? Now, the quarter could not be uglier with CSV. The revenue declined 7.9%, GAAP net income declined 55%, cash from operating activities declined 29%. This is all compared to the third quarter of 2021. But of course, in the third quarter of 2021, they had peak COVID cases. They had a lot of COVID cases, and this was pretty high volume, and now in 2022, it's just not happening. But this is what the management said about the quarter, and I believe the market a little bit misunderstood what they said. Now, they said the funeral same-store contracts of 9,500 in the third quarter reflect a 14% volume growth from the third quarter of 2019, and it was flat compared to the quarter of 2020. And people are just comparing it to 2021 and are saying, it's down 50 or 60%. Well, of course, because they had a massive spike in the third quarter of 2021. But not just that, there's a lot of seasonality with the business. And they said historically the first quarter is the highest quarter volume, followed by the fourth quarter, then the second with the lowest volume in the third quarter. This is due is correlated mainly with the flu seasons and things you get in the winter, which is why normally the third quarter is very, very slow in terms of volumes. But 2021 was different because you had COVID, which is why the comparison doesn't really make sense. But again, death rates are more normalizing, and it's spooking investors, that a lot of people maybe died last year, and maybe less people are going to die in the future. But despite that, the company has higher volume than 2019, mainly from, one reason, which is a lot of acquisitions, and I'm going to talk about it later. Okay. Now, looking again at the free cash flow. In the quarter, the company made around 16 million of free cash flow. Last year in the same quarter, they made 24 million of free cash flow, which is, again, not a good comparison in my personal opinion. But if you annualize 16 million a quarter, and let's assume it just stays at 16 million, that's pretty close to over 60 million of free cash flow every single year. All right. Now, the main thing that I really like with the company is it's not a dying company. And a lot of things have changed since 2019, as I told you. Now, you could see how resilient the company has been in terms of revenue. Revenue pretty much grew every single year, even in the 2008 financial crisis, which many people couldn't do. And it pretty much compounded the growth every single year. But then you could see a big spike from 2018 to 2019, and then it really spooked up in 2021. Well, the main reason for such a big spike from 2018 to 2019 is because the company started doing acquisitions. They started reinvesting the free cash flow into acquiring more funeral home type of businesses from families that just wanted to sell them. They inherited them and they were not interested in running it. So CSV was, acquiring them, and this really helped fuel up a lot of growth. And the company now is going to keep doing that, as this will really help expand their margins and expand their revenue growth much faster than before. Before, all they had were price increases. Now they're going to have price increases and acquisitions, which is one of the reasons why I'm excited about the business. And as you see from 2011, it wasn't a dying company. It compounded 20% every single year compared with the Russell of only 7% every single year. But one of the other reasons why I'm interested with the company again is the whole thing about the business. The business is very, very resilient. We have inflation, we have a recession, we have a war in Ukraine, we have higher interest rates. No matter what we have, the business is still here and it's still going to be, making money and stuff, which is, as you see here, the company has a little bit more debt than usual, mainly because, again, the business is resilient and they take on more debt to do acquisitions, and then, they cover up the acquisitions with the free cash flow, and then they just, keep growing. And the company has showed a pretty good track record of leveraging up in 2019, creating value for shareholders, and slowly deleveraging back down to their historical multiple. And now recently they acquired 3 new acquisitions, which are higher margin, and they're gonna integrate them within the business, and they should start showing results in 2023, again offsetting the modernization of death rates, which the CEO expected to modernize in 2023. Now here is the upside of the stock. And one of the other reasons why it actually went down so much is every single quarter they have something called the rolling 4-quarter outlook. All right. Now this outlook, is like a guidance for the next 4 quarters of what they believe, things are going to be, because it's pretty resilient and they pretty much get, either the same or more volume every single year. All right. Now, they did not issue the outlook in the 3rd quarter. They said they're going to wait till February of 2023 for their fiscal year to be over, so they can really give a precise number, as deaths are more kind of going back to normal. They are normalizing. So they want to make sure they give the right guidance. But this is the last guidance that they gave in the previous quarter in Q2 before this one. They had a adjusted free cash flow between 68 to 72 million. Now this is 70, you could take a good number of 70 million of free cash flow. Now I'm assuming that the company, in the next 5 years, it doesn't grow. Like the death keeps, it normalizes, it even goes down lower than pre-COVID, which is very unlikely to happen. But let's assume, everything stayed flat, over the next 5 years. And just the company was just able to get at least back to the free cash flow that they, put up for guidance in Q2 of 2022, and it's around 70 million. So if I assume a 70 million of only free cash flow, which is flat, over the next, in 5 years from now, and I give it a 10 multiple. Why would I give it a 10 multiple? Because they would have deleveraged, a lot of their loans from now till, around 5 years from now. All right. So that should push up the company to the historical multiples that it traded at of 10 times free cash flow. So if you take the 70 million and you time it by, 10 times free cash flow, that's a 700 million market cap. Current market cap is 350 million. So worst case, in my opinion, that's around a 2x from here. All right. Now, there's something else that could happen, which what the CEO was talking about. And he's been in the business for over 30 years. And he's saying that from now till Q2 to Q3 of 2023, things have to be back to normal. And they're likely going to be higher in terms of volume than they had in pre-COVID. And they have 3 big acquisitions that are going to offset the lost volume. So if you believe the company can keep doing acquisitions and the death rate is going to modernize over the next year, and things are going to get better and they're going to grow like they grew before, and if they were able to get to 100 million of free cash flow, which is not far from here if they do a couple more acquisitions and pay them off, if they get to 100 million of free cash flow, 10 times multiple, that's $1 billion market cap. That's over a 3x from current prices. So this is what I believe the upside is with CSV. Is there a lot of risk? Of course there is, but basically the market is saying that after COVID, people are going to stop dying. Now that doesn't mean that the stock cannot go lower, all right? It doesn't mean that. It doesn't mean that I'm not maybe making a mistake, or maybe the stock get even more undervalued than it already is. But I can determine when something is, fairly valued or undervalued, and if it goes more undervalued and the business is still the same, or if sentiment gets too bad, that's normally a sign to buy. All right. Now, this is not financial advice, and I'm not recommending, anyone, those stocks if you don't know what you're doing. This is just ideas for you to look deeper into and determine if any of those stocks maybe you like for your portfolio, or if you'd like to buy it or even short it or whatever you do. So it's up to you. All right. So again, no financial advice. Thank you for watching the video, and I hope to see you in another one.